And I do see a time where the world finally, that all at once moment triggers, and there is a dumping of dollars, there is a dumping of treasuries that accelerates not just what we've seen slowly and methodically and orderly, where China has gone down to 750 billion from over 2 trillion, almost 3 trillion. That's the little by little by little. The all at once hasn't happened yet. But what I do think, when the all at once happens, it will shock people. Like to Rafi's point, no one knows that silver is over 30 unless you're in our camp. And it's a very big deal for the people in our camp. Most people wouldn't know a silver dollar if it fell on their foot, or the ramifications of rising silver, what it really means, or massively rising gold and de-dollarization. All of this stuff we focus on, the public is asleep.
Since World War I, the dollar's global economic importance has grown significantly. After the war, America's allies exchanged gold for goods, enabling the US to build the largest gold reserve. Many countries then linked their currencies to the dollar, making it the primary global currency. By 1999, the dollar comprised 71% of the world's foreign exchange reserves, while European countries introduced the euro. This shift started to reduce the dollar's dominance as the main global reserve currency. According to the International Monetary Fund, IMF, the dollar's share of global reserves fell from 62% in 2010 to 58.41% in 2023. This gradual decline could eventually lead to a sudden, dramatic shift, an all-at-once moment where dollars and treasuries are massively sold off. Such an event would surprise many, as the warning signs have accumulated gradually but steadily. Andy Schechtman, CEO of Miles Franklin, observes that global sentiment against the dollar has intensified, especially after the US froze Russia's dollar reserves, prompting other countries to seek alternative payment methods. They focus on using their currencies more and increasing their gold reserves instead of holding dollars. The massive money creation in recent years, over $6 trillion in 1 year, has led to significant inflation and a weakening dollar. Compounding this issue is the substantial money creation during a period of near-zero interest rates, which caused major distortions in asset prices. As interest rates rose, this money creation continued, fueling further inflation. The current situation indicates potential stagflation, rising prices, higher taxes, and minimal economic growth. The shift in global sentiment is clear, where once the world eagerly sought dollars and US treasuries, this is no longer as desirable or inspiring as it used to be. Andy suggests that de-dollarization will make holding dollars increasingly unattractive, leading to significant changes in the global economic landscape. As countries diversify from the dollar, the world will become less reliant on the American financial system. We will present clips from Andy Schechtman's with Arcadia Economics. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
Said the exact same thing, just differently not in the same words, but the same ideology for 2 years now. That's what happens. The little by little, the logarithmic decay, the chipping away at the hegemony of the dollar, all of these countries that are not Western friendly in the Southern Hemisphere chipping away at the settlement status of the dollar, trading in local currencies, replacing those local currencies with gold and oil in terms of excess reserves that normally would wind up in treasuries. That little by little by little by little, the debasement of the settlement and the reserve status of the dollar is growing much more profoundly. And I think this is a situation where, when you talk about rising prices, look, if you spend $100 every second of every day, 24/7, it would take 1,970 years to print just as many dollars as we've spent in 1 year, over $6 trillion, or created in 1 year. The level of inflation that was created by money creation, the classic definition of it, is exactly what we should be expecting. And that hasn't even flushed its way through the system yet. The debasement or the falling dollar is a reflection of the weaponizing of the dollar, is a reflection of the fact that these countries no longer trust us. It's like a glass broken into a million pieces. When you break it, you can't put it back together, at least not very easily. And so what you are seeing is a byproduct of the same time of the ramifications of massive money creation, most of it done over the years where interest rates were near zero, creating huge distortions in asset prices. The end of it is rates were still rising. Well, they were still creating tons and tons and tons of money, which is going to fuel the inflation. And as rates rise, maybe that head towards that stagflation. But the point of it is that I think there's a disconnection now. Whereas in years past, everyone wanted dollars, everyone wanted treasuries, everyone wanted to be part of the American system, and that system no longer, I think, is inspiring as many participants as it once were. So yes, I see this exact same way that Rafi does, maybe hyper stagflation, higher prices, higher taxes. What did the knucklehead say? If he wins again, he wants to raise capital gains to 44.5%. He wants to raise income taxes. He wants to impose a mandatory tax on unrealized gains for the very wealthy, higher taxes, higher inflation, little or no economic growth. And I do see a time where the world finally, that all at once moment triggers, and there is a dumping of dollars, there is a dumping of treasuries that accelerates, not just what we've seen slowly and methodically and orderly, where China has gone down to 750 billion from over 2 trillion, almost 3 trillion. That's the little by little by little. The all at once hasn't happened yet. But what I do think, when the all at once happens, it will shock people. Like to Rafi's point, no one knows that silver is over 30 unless you're in our camp. And it's a very big deal for the people in our camp. Most people wouldn't know a silver dollar if it fell on their foot, or the ramifications of rising silver, what it really means, or massively rising gold and de-dollarization. All of this stuff we focus on, the public is asleep. And so I see the exact same thing: higher prices, higher yields for longer, and continued de-dollarization and de-treasurization that we continue to foster. Where Janet Yellen has the nerve to tell China, if you give 1 penny to Russia to aid their war machine, we're gonna sanction your banks, your companies in Beijing itself. Don't worry that we've given 200 billion to the Ukraine with no congressional oversight. That's our business, and we're the world reserve currency. I think that's exactly what will happen now. To your point, what does it look like? Who knows? I mean, yeah, I think it won't last forever, but there could very well be a time where things of value are used to barter, because who's going to want dollars in an environment where no one wants to hold them for any significant amount of time whatsoever?
In today's economic landscape, the surge in interest rates has brought renewed attention to the ever-expanding U.S. federal government debt, now towering at $34.56 trillion as of mid-May 2024. This doubling of debt over a mere 15 years underscores the cumulative impact of sustained deficit spending, which often garners heightened scrutiny during election cycles and periods of increased government interest expenses. However, contrary to common belief, inflation is not the root cause of our economic challenges. Rather, it's a symptom of deeper underlying issues. This realization implies that our spending behaviors will unlikely undergo significant transformations, perpetuating ongoing deficits and increasing interest rates. Andy asserts that the precious metals market is a prime example of this departure from traditional economic indicators, with gold and silver prices now more influenced by demand than factors like treasury yields or the dollar's strength. India's intensified focus on silver and China's growing appetite for gold further emphasize this trend. Recent developments in the silver market furnish empirical evidence of this shifting demand landscape. Silver prices in Shanghai surged to $35.31 per ounce on the futures exchange this week, marking an 8% uptick from the previous Monday. This remarkable trend diverges significantly from conventional market norms, where a robust dollar and high interest rates typically precipitate a decline in gold prices. However, Andy suggests that even amid economic conditions, signaling a prolonged need for higher rates, pursuing non-dollar denominated liquidity is outstripping the demand for dollars and U.S. treasuries.
Yeah, we're a country addicted to spending, adding $1 trillion in debt every 100 days. Inflation is the symptom, not the driver. That's the bottom line. And our spending habits aren't going to change anytime soon. And so deficits will get bigger, interest rates will rise further. And, the term in economics, Gibson's paradox, which traditionally speaks to the inverse relationship between real interest rates and the price of gold in particular, in this case, seems to not be as relevant in an environment where gold and silver prices are not aligned with their usual drivers, in particular the 10-year Treasury yield and strong dollar. Because as Vince will often say, they just want the metal. And I think India just wants the silver. China just wants the gold. Of course, I'm generalizing there. I think China is a big buyer in silver as well. But, you can, well, and let's say there's empirical evidence to that showing that in silver this morning in Shanghai, the market opened up, limit up, and opened up at $35.38 an ounce. But on the Shanghai Futures Exchange, it opened up 8% limit up on Monday morning. And so when you talk about the drivers that typically would spell a reversal in the price of gold, a strong dollar, strong interest rates, in this case, and an inflationary agenda that seems to be running out of control, which would speak to higher rates for longer. It doesn't matter. I think that's really what's different this time, is that the pursuit of non-dollar denominated liquidity is outpacing the demand for dollars in U.S. Treasuries.
With all fiat currencies heading to obsolescence and de-dollarization advancing aggressively, Western gold enthusiasts are wisely shifting their focus from short-term fiat profits to accumulating more gold. In this context, countries like those in the BRICS bloc, frustrated with the US, are developing their own systems. Share your thoughts on Andy's prediction in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Until next time.